Good morning, good morning, good morning. We are just allowing some additional participants to sign on, but we are here today for the PSOJ's Economic Policy Committee, their first Roadmap 2.0 forum for this year. And as we continue to let in some participants, but all our key speakers are here and ready to go. My name is Amashika Lorne. I am the Marketing and PR Manager with the PSOJ, and I will be your moderator for this session. So as we just continue to let in a few more people, I'll just give them one additional minute to do so, and then we're going to get started. We have quite a bit to get through today, but it's going to be a very exciting session. And the first person that I'm going to have speak with you is our Executive Director at the PSOJ. Her name is Mrs. Amiga Breeze McNabb. So Amiga, thank you for joining us, and let's hear your opening remarks.
Okay, thank you. Morning, Amma. Morning, members of the panel. Good morning to everyone. It is my pleasure joining you here all today for this informative session put on by the PSOJ's Economic Policy Committee as part of our Roadmap to Jamaica 2.0 series. You know, for the past 3 years, we've been operating in an uncertain environment, you know, having to deal with lockdowns, restrictions, supply chain issues, inflationary and interest rate pressure, and potential food and energy security crisis. We understand that for companies, it is extremely hard to plan as well as to determine how to even price our products in such conditions in a market which we know have a low purchasing power. And we do have other structural issues that have economic implications that must also be addressed, such as crime, as well as education, digital and social transformation. But with that being said, it has not all been doom and gloom, as on the other hand, we see companies seizing opportunities through listings, acquisitions, joint ventures, going into new export markets, developing new products. And some of this is actually in keeping with moving towards a digital and green economy. So while we focus on our company numbers, though, at the PSOJ, we believe that it's important that we understand what is happening at the macro level to also inform the decisions that we make internally. So the EPC, they've been very active in advocating on the macroeconomic issues, and our co-chairs and members are here today to inform and build capacity around key indicators. And more good news is that we plan to continue sharing vital economic data with the reinstitution of our economic bulletin that will resume this month. I thank you all for joining us today, and I look forward to a productive and engaging session. Thank you, Amma.
Thank you so much, Amiga. All right, and as you heard, we are going to be resuming our economic bulletin from the PSOJ, so please to check those emails on a monthly basis, and just to go through different types of communique that we send out. All right, at this time, we are going to invite Mr. Theodore Mitchell. He is a member of the Economic Policy Committee to take us through a presentation. And Theodore is really going to be breaking down all of those technical terms for us, showing us a really nice overview of what has been happening. And then afterwards, we will go into a question and answer segment. All right, so as he's going through, you can even make note of the particular slide and your questions until we get to the question and answer segment. All right, so Theodore, it is now your time to step forward.
Are you seeing my screen, gentle folks?
Yes, we are.
You're seeing this? Are you seeing the presentation?
Yes, we are. We just need to go in presentation mode, but we are seeing your table of contents up and ready, and he's showcasing, some of the things that we will be going through today. All right.
Guide me, please, to get back to the presentation mode, please. Insert. 1 second. 1 second. I'm having a bit of a technical issue.
So Theodore, if you bottom right of your screen, bottom right.
Okay.
Bottom right. Let's come down a little bit more.
Okay.
You see there's a little icon there. Come over a little bit more to your left now. A little bit more to your left. Come over to your left. Come over. We're right there. No, the other one right beside it to your right. Yes.
Okay, slideshow. All right, good. All right, good. Sorry, gentle people, my bad. Yes, right. Pleasant morning. Thank you for having me. So it is that today we're looking at tracking our macroeconomic performance year to date, and the question that we have to ask is is it stormy clouds or a silver lining? And by the end of the presentation, I think it is that we should be in a position to discern whether it is that we're facing those stormy clouds, or it is that they are silver linings that we will be seeing. Now, the nature of the presentation is that we'll be looking at the global outlook, the domestic outlook, good, and we'll look at some of the issues which we're confronted with on the global scale as well as the local scale, and we'll look at inflation, exchange rate, etc. Good. So we look through at the global level first, take it to the domestic level, and then at the end of it all, we should reach a conclusion as to what it is that we think will occur, at least on the domestic side. Now, notably, there are four key themes that dominate the global economic landscape. One, the issue surrounding health issues with COVID-19, high inflationary pressures, and increase in policy rate, as well as geopolitical risk. Now, notably, we have seen an increase in commodity prices, and that has caused significant impact in terms of global inflation. In fact, the US inflation rate up to March was upwards of 7%. In the UK, it's the same thing in terms of high inflation, right? And that is in part being driven by the high commodity prices. We have seen over the last couple of months where it is that prices have increased, and we think it is that they have reached somewhat of an apex. The likelihood of price increasing beyond these range that we're seeing is relatively subdued. But this will say, with the geopolitical conflict, I think perhaps it would have to escalate beyond what we are seeing now for price levels to move beyond what we are seeing. So the outlook from the global perspective is that by about Q3, Q4, you should start seeing price level off, and inflation is likely to trend down. Of course, it is that risk is tilted towards the upside. As I indicated, the increase in geopolitical conflict could result in increase in commodity prices beyond the level where we are now. But in the event that does not occur, we do expect price to taper off and inflation expectation to taper off as well. Sorry about that. Right. On the growth side, the growth outlook is looking relatively positive, at least for 2022, but nonetheless, the risk level is relatively elevated, and that is reflected in terms of what is known as the fixed volatility index. We note that in 2021, the fixed index was within normal range, but it has somewhat increased over the last couple of months. It's indicating that market players are somewhat fearful of what is happening, and you're seeing it reflected in terms of the volatility index. Good, and this is in fact reflected regarding the projection for growth outlook, which I will look at in later slides. Now, with what is happening regarding high interest rates, or rather high inflation rates, we have seen where it is that rates globally are going up, right? And notably, we're seeing it reflected in terms of the United States yield curve. There has been a shift in the yield curve, and looking at the yield curve from last year relative to this year, we see where it is that it has, at least on the lower end of the curve, it has increased upwards of 200 basis points. But there's something interesting which is reflected in the yield curve, in that if you look towards the 2-year as well as the 15-year yield curve, it is relatively flat. under normal circumstances, when the economy is expected to grow and things appears normal, you'll see the yield curve relatively upward sloping, as in the yield curve in last year, which is the bottom one in yellow. But now it is that it is somewhat flat, indicating to us that there is some level of trepidation regarding market players, and potentially we could see a slowdown in the economy, all things being equal. This graph highlights what is happening globally in terms of the high inflation rate, not just in Latin America, but as well in G7 countries. So it is that, we see 2020 where inflation rate was relatively subdued, but there have been subsequent rise in inflation because of, increases in commodity prices, which is driving a lot of inflation in various countries. Consequent on the rise in inflation, what we have note is that central banks have begun the process of normalizing their interest rate, notably pre-2020, 2019, thereabout, and even before. We saw where it is that central banks in the United States, the UK, were engaging monetary policy, which were relatively it facilitated easing in terms of the flow of funds and borrowing, because rates were relatively subdued. But consequent on the high inflationary pressures and inflation expectation that they're seeing, we see where it is that they have begun the process of increasing rates. Notably, in the developing world, the rate of increase have been significant. They started in 2021, and it's continued into 2022. We do expect the rate of rate rise from the policy perspective to decline in the developed world, but for it to pick up in the developed world. And we saw where it is that the United States Treasury has indicated, or rather Federal Reserve has indicated, that they will be increasing the policy rate. In fact, they did so in March by 25 basis points, and it is that they are likely to increase rates at least another 4 times this year. So the theme is one where it is that we are in an environment of increasing interest rates because of the high inflation expectation, which a lot of countries have to be grappling with. So with respect, this brings us to the global growth. Now, the IMF essentially is projecting growth of 3.6% for 2022, and for 2023, they're projecting growth of 3.6%. Now, the growth is relatively distributed somewhat evenly across developed and the developing world. But notably, the risk is towards the downside. In fact, a few months ago, which is last year, the IMF was projecting global growth of 4.2%. It has subsequently been downgraded to 3.6%, owing to the high inflation expectation, as well as the geopolitical conflict. So, we're seeing where it is that, yes, growth is positive, but there are risks that are abound, and it is essentially to the downside. So the prospect does exist that we could see, growth trending below the forecast level because of the high level of uncertainty which exists in the market at this point in time. Now, there are risks associated with what we have spoken of in terms of the growth level and so on. Good. And notably, we are seeing risk in China, especially on the part of their property market. There was a major collapse of one of their main property players, Evergrande, and that could, if the central bank does not deal with that, it could lead to contagion and could have significant impact in terms of their economy. Notably, we in our local economy, we did have the issue with regards to FinSac. If it is that things, the Chinese government doesn't take hold of the situation, then the contagion effect could have a significant impact on their economy. Now, regarding price pressure, we're still seeing where it is that there's price pressure in the economy, global economy. If that remains, it could lead to further monetary tightening, increase in interest rate, have a negative implication for growth. So if it is that, as I indicate, inflation expectation and does not trend down as expected, then we could see where it is that central bank continue the process of tightening monetary policy, which could further imperil the economy with regards to the growth path. New COVID cases could have negative implication as well, and notably geopolitical conflict. We're seeing issues relating to China and Taiwan. A misstep could have a major implication for the global economy. We keep those, we are very mindful of what is happening. So, despite the positive outlook regarding growth, notably there are major headwinds which could have significant impact in terms of the growth outlook for 2022 through to 2023. This brings me to the domestic macroeconomic scene. So firstly, we delve into local growth. Notably, leading up to the COVID pandemic, we saw where it is that the economy showed significant growth, over a number of quarters. But consequent on the COVID pandemic, the economy went into decline. In fact, for the fiscal year, the decline was up 10.2%. We're currently on the rebound. However, it is that we're not out of the woods. In fact, the economy is not yet back to where it was in 2019. So it is that the sort of environment within which we're in, we're seeing growth, but there are still headwinds, and if it is that we're not mindful by way of increasing the policy rate, etc., it could have negative implication in terms of the growth going forward. But notwithstanding, we do expect to see growth in the economy, in particular sectors which have been showing signs of green shoot: construction, tourism, manufacturing, and distributive trade, which are benefiting from the opening up of the economy and increasing remittance flows, etc. There are concerns from our point in terms of the growth outlook. We utilize the commercial bank loans as a leading indicator. We saw where it is that in commercial bank credit at in 2018, 2019 was growing at a rate year on year upwards of 19-20%. We do observe that there is actually a slowdown in lending, in particular to businesses, because of the increase in the policy rate. Now, that has a negative, that could have a meaningful impact in terms of investment in the economy. So it is that notwithstanding our view regarding the economy continuing to grow because of the momentum that has been building from 2021, with what we're seeing on the credit side, in particular as it relates to business credit, those sort of stress could have implication for investment and the growth going forward. This brings me to the exchange rate. Regarding the nominal, the exchange rate has been somewhat, we're not seeing significant depreciation over the last couple of years, notwithstanding what is happening. Now, notably, we see where it is that the current account actually moved to a surplus last year. Now, the economy in the past, we're used to deficit of 6-7%. Now, the current account just speaks to inflows and outflows of cash by way of exports and imports. So to the extent that we're importing less somewhat and exporting relatively more, and the current account is relatively well behaved, we're seeing it filter through to the FX rate. Good. Notably, it is that the FX rate remains relatively well behaved. We notice a phenomenon where at the end of the quarter, there was a tendency for the FX to appreciate. Now, that was in part because there were some entities that had balance sheet issues in terms of US liabilities. They have corrected that. So we do expect to see relatively smooth depreciatory path as it relates to the FX. We're in an environment where it is that Jamaica's depreciation is relatively higher than its trading partner. So it is that, the currency is expected to depreciate. Notably, from the central bank perspective, in terms of the NIR, it is relatively high. So it is that where the shortfalls do exist, they're in a position to put funds into the market so as to ameliorate the risk of depreciation being out of whack and speculatory forces coming into the market. Now, as a result of the high rate of inflation which we are seeing globally and locally, we note where it is that the domestic inflation rate is above the forecast, the targeted range for the Bank of Jamaica. So as a result of that, the BOJ has increased the policy rate since November, moving it from 0.5% to 5%. Now, that has significant impact for capital formation through loans, right? And I did show the graph in terms of the slowdown in corporate loans, right? And we note that the policy rates serve as a signal for interest rate general in the economy. And one of the rates which we track is the treasury bill yields. And we have seen where it is that, the two rates usually, they are highly correlated. And since the increase in the policy rate, we have seen where it is that T-bill yields have moved from lows of 1.5% to upwards of 8%. Good. Now, while it is for the average individual, it doesn't have a major impact. It has implication for the fiscal account, as it is that 34% of the domestic debt is actually related to the T-bill yields. So the increase in yields have implication for the for the economy on a whole through the fiscal account, as well as through credit because of the increase in interest rates which we saw earlier. Now, looking at the domestic yield curve, we're seeing where it is that the domestic yield curve has increased more than 100 basis points, 1% across the board, right? Now, we have not had many issuances by the government of Jamaica in recent time. In fact, we note in early January where it is that the GOJ issued 2 instruments and they had to pull them because yield as high as 30 and 50% were accepted. Good, but at the time the GOJ made these issuances, liquidity levels were relatively low, and it was communicated to the market. Now, they are coming into the market again this month. Now, if it is that they're opening the 2025 and the 2044. Now, we wait on these instruments with bated breath, so to speak, because it is that. And we do anticipate an increase in yield. We do not know the magnitude just yet, but a significant rise in GOJ yields have implication in terms of the asset of the banking system. Good, there's an inverse relationship between increase in yields and reduction in terms of the pricing of financial asset, that is GOJ asset. Good, but the increase in interest rate, local interest rate, is having an implication on a number of interest rates within the system, both on the commercial lending side as well as from the perspective of the GOJ, as reflected in increase in the yield curve. As noted, the inflation rate is way above what it is that the BOJ is targeting, that 4 to 6% range. It's, in April, it was 11.8%. We're seeing where it is that the month-over-month inflation rate is decreasing. It is relatively early days yet. To the extent that price pressures from the external side is still there, we expect to see somewhat of a slowdown in terms of the month-on-month change in in inflation, good, and over time, by about Q3, Q4, we should start seeing inflation trend down. But the risk, as always, is tilted towards the upside, notably because of what is happening on the global scene. Within the local consumption basket, 35% of it is determined by local production. So if it is that there's a weather-related shock, as heavy rains, or if there's drought, we could see where it is that local food production fall, and it will have somewhat of a negative impact on the inflation rate, albeit not it's transitional, it's not long, but that feeds into our view in that the potential does exist for inflation to remain elevated over an extended period. But barring that, with improvement or expected improvement in terms of global supply later down the line, we do expect to see by about Q4 into 2023, inflation start trending towards the targeted range of 4 to 6%. This brings me to fiscal policy. Now, I spoke about increasing interest rates, the inflationary environment, and so on. And, we anticipate growth in the local economy. And all these things, variables, filters into the fiscal account. Now, notably for fiscal year 2022-2023, the GOJ is planning to generate revenues of $746.7 billion, right? And we're expecting a primary balance of 5.9%. We are anticipating a narrow GDP surplus of 0.3%. Good. All look relatively well and within range, but notably the environment within which we're operating is relatively risky. As it relates to government revenues, revenue, there's what we call tax buoyancy. And buoyancy is about one. There's a one-to-one mapping, some 0.91 in terms of change in the nominal GDP versus overall revenue and taxes. So from the high inflation will not have, actually has a positive impact in terms of government revenue. So if there are surprises regarding inflation being outside the expectation of, or above the expectation of the government, or what is programmed in the fiscal account, that could have a significant impact in terms of revenues. Good. But where there are concerns for us is on the part, well, there are two concerns actually. One which I'll look at later, wages and salaries, and the other is with respect to interest rates. As I indicate to you, 34% thereabout of the domestic debt is actually linked to the treasury bill. So, for every 1% increase in T-bill yield, it actually results in $2 billion rise in terms of debt payment. So, we have seen where it is that T-bill yields have so far increased by over 600 basis points. So that will add, netting off, that will add about $10 to $12 billion to debt servicing this year. Good. And, we spoke to the rise in yields locally. The GOJ is coming back into the market to issue amortizing debt, or rather to issue debt to meet amortization requirements. So, that will add additional burden in terms of debt servicing because of the increase in yield there. Good. So, while it is that, looking at it, a $12-14 billion increase in debt payment for this year is not significant on the budget. Over the years, it has implication, because you're looking over a 5-year period, that's over $50 billion. So there's a compounding effect there, right? So there's concern on our part regarding increasing interest rates and the implication on the budget, as well as the implication, with respect to investment in the economy. Good. So here it is that I have, looking at revenues, we have seen where it is that, revenue has seen a relatively has been increasing over the years, save and except for 2020 when it is that we had the recession, good, but it has spiked up towards 50% in 2021 year on year, and for this year we do expect revenues to increase upwards of 10%. Even in the event of an inflation surprise, we expect revenues to go beyond what is programmed in the budget. But where it is that the risk lies is with respect to inflation, as well as regarding the wages and salaries, which brings me to that component in terms of wages and salaries. Now, notably, the GOJ is still is in dialogue with various arms of the civil servant in terms of increases in, well, not just increases in salary, but rather to bring about normalization in terms of some of the things that are embedded in the wages and salaries. Now, looking at the budget, we're seeing where it is that wages and salaries account for over 11% of over 11% of GDP rather. Now, the government is committed to keeping wages and salaries at 9% of GDP. Good. Any negotiations that pushes wages and salary above that 11% mark, it is going to be structural, and it's going to be difficult to correct. So it is that the government will have to put corrective measures in place. Either it is that they will have to cut other expenditure, most notably capital expenditure, or they will have to increase revenue flows in order to ensure that the primary balance is maintained. Notably, the government of Jamaica is committed to reduce debt to GDP by 60% by fiscal year 26-27, and increase in wages and salaries beyond the current level could have a negative implication for that target. So it is that, as I noted, that is of major concern to us, and it is something which I know, Mr. Keith Duncan and other members of the team are in dialogue with the Minister of Finance, so as to get a clear picture as to what it is that the government will do in terms of correcting any fiscal slippage which may arise as a result of the increase in wages and salary due to the current exercise which is underway. So so the general theme is one where it is that we expect improvement in the economy. We're seeing where it is that inflation is elevated. However, it is that we do expect it to trend down. We note where it is that interest rate is on the rise because of increase in the policy rate, etc. But with the risk that exists in the economy, and this brings me to the risk. All right, good. We could see where it is that there's some reversal with regards to the policy rate, etc. Now, steep slowdown in terms of global growth could have negative implication for things like remittance flow and tourism. Good. So it is that we could see where it is that the economy actually move from growth into a recessionary mode, or if it is that global growth slow down beyond what it is that we're expected. On the domestic side, the high inflation is of concern. If it is that inflation remains elevated over an extended period, I spoke about inflation trending down by Q3, Q4. If it is that the rates are stubborn and remain well beyond the levels which we're seeing, it's possible that the BOJ may increase the policy rate, and that will have a negative implication in terms of the growth for the economy. Of course, it is that COVID-19 is not over as yet. In fact, we saw yesterday where it is that the United States issue an advisory where it is that Jamaica has been moved to tier 4 as it relates to the risk level for COVID-19. So they are telling their citizens to be very careful coming to Jamaica. Now, it doesn't have just implication for tourism flow, but for the local population on a whole and for the economy. We note, during the heights of the COVID pandemic, the government restricted movements, and it had negative implications for a number of sectors, in particular tourism and entertainment. So an increase in COVID cases could see it could lead to a situation where the government actually reimpose some of those restrictions, which could actually undermine the economic growth. On the other extreme case, fiscal slippage, while it doesn't have necessarily will have implication now for growth, over the medium to long term, it will have negative implication. We note in the time leading up, well, after 2008, 2013, thereabout, where it is that the fiscal deficits were elevated, the government was very active in the market, and that led to significant rise in terms of interest rate. Growth was relatively low for the 30-year period leading up to 2017. The growth rate was under 0.7% per annum. So fiscal slippage could have negative implication in terms of the growth outlook, in the medium term as well as the long term. So that is something which we are cognizant of. And as I indicated to you, I know our chairman, Mr. Keith Duncan, is actively engaged with the Ministry of Finance so as to ensure that they maintain on the right path in terms of the fiscal outlook. So we have come to the end of the presentation. I trust that you have garnered a lot. So my bad. Right. So the key takeaways from it is that the geopolitical risk are driving commodity prices upwards. We're seeing where it is that is happening regarding higher global inflation. There's aggressive sanctioning of Russia, which is having negative implication with respect to oil price and other key commodities. Good. And that has filtered through into high inflation. And we're seeing where it is that crude oil prices are relatively high, and the high inflation has negative implication for disposable income and for global demand. Now, in many countries, including the US, you have very little appetite to pursue expansive fiscal policy. Now, recall it is that during the COVID pandemic, the government provided a lot of support and so on in various countries. So it is that debt level has risen significantly. So increasing spending could have negative implication, and in fact could precipitate a debt event in some countries. So the appetite to further increase spending is rather low at this point in time. Now, the key question, which we would like to which we have asked is, will the slowdown be material enough to trigger a recession in terms of locally and globally, right? That is, we're not too quick on the draw to say, yes, that is going to happen. But if indeed, the situation regarding the geopolitical tension increase significantly enough, or inflation remains elevated and policy rates are going up, then we could see a situation where we move from slower growth to actual negative growth. Now, the history of the United States has shown that high oil prices have a negative effect in terms of growth. In fact, every time that oil price has risen by 50%, the United States fall into recession. So that is something that we are watching. Good. It is not to say that, because oil prices are up by these upwards of 50%, the US will fall into recession. But the truth is that, in the past, we have seen where that has happened. So it is in our crosshairs. All right, in terms of an event which could happen with a fair degree of probability. Now, high inflation is driven by high commodity prices, and it will start to bite into our disposable income. That is a fact. And the US economy has a strong labor market, but real wages are falling. And that is something which we're mindful of because of the high inflation. So high inflation is biting the pocket or the disposable income of household. But notwithstanding, we see where unemployment in Jamaica is actually falling. In fact, because the economy has opened up and the BPO sector is back online, tourism, etc., we see where it is that, unemployment is on the in the decline rather, but notably real wages still remain relatively stagnant. So That's the end of the presentation, team. Thank you for enduring me for the last 35 minutes. At this point in time, we'll open up to you to ask whatever question you have, and myself, Adrian, and the co-chair will be more than happy to impart to answer your questions. So Amma, over to you.
Thank you so much, Theodore. So of course, Theo is a member of the Economic Policy Committee. He's now going to be joined by Dr. Adrian Stokes, who is also the Vice President of the PSOJ and the Chair of the EPC, as well as Richard Pandohie, co-chair of the EPC and the CEO of CEPROD. And so you can field your questions to them, and they will be here to defend anything that was in the presentation or any other economic related matter. Also, as the questions start to come in, Al Edwards, you'd like to pose one? Let's see. All right, so Al, I'm not seeing your question in the chat, so type it for me. Okay, Al?
Yes, can you hear me?
Yes.
Oh, hi. Good morning, everybody. Very good presentation. One of the things perhaps that you didn't quite mention, and I'd like your input on, is we're expected to have a slightly more intense hurricane season according to various forecasts. How do you see the impact on that given prevailing conditions now?
Okay, thank you for that question. It's not a matter of that we ignored it. It is somewhat embedded in presentation. I just bring it out. We didn't bring it out. Sorry. No, hurricanes, weather-related shocks have negative implication for the Caribbean and Jamaica. We saw it with Bahamas just recently, where it is that it had a major impact in terms of on their tourism industry. Jamaica, like Bahamas, is heavily tourism dependent. So in the event of a weather-related shock, given what exists now, it could further compound the situation, leading to a decline in growth, and could amplify inflationary pressures because it is that local production will be taken offline. Good. So in the back of our head, in terms of the risk analysis, that remains it is forefront in our head because of the implication that it could have for the agriculture, tourism industry, and across industries in general. Mr. Pandohie operates within the agriculture sector through his the farm in St. Thomas, and he knows very well the sort of impact that weather-related shock have on his business. Good. So the general take is that hurricanes do have negative impact in terms of growth and on the macro fiscal profile. I note that the government actually has a relationship with the IDB, in fact, to provide support in the event of, within the budget itself, there is actually about $4 to $6 billion in terms of contingency funds, which could help to support, while it is not sufficient enough, but we have that. And then it is that we do have the catastrophic risk insurance that, could provide some amount of fiscal support to get back the country on track in the event of a hurricane.
While I'm at it, do you mind if I ask you another question?
Sure, go ahead.
Al, can I make a comment on the issue of weather?
Yes, sure, Rich.
Speak about the hurricane season within the Caribbean. But the impact of weather, the one thing we have learned for the last 2-3 years is interconnectedness throughout the global supply chain. And a weather event in another country could have an impact on our macroeconomic situation, especially on supply chain factor. You have seen issues of weather issues in Brazil, in South Africa, in India, for example, impacting supply into the global economy, which in turn affects our pricing, which is a key part of the inflation driving issues here. So, I want us to make sure and look at whether we kind of start moving away from just our little rock and see how it plays within the whole global situation.
Okay, it's a good point there. Yes, I was going to ask you, I thought the points you made, the public sector were particularly pertinent, given the fact that, yes, we're looking at, they say 9% of GDP, so already 11%, but given rising inflation, the geopolitical background, the rest of it, you can see that the public sector is getting a bit agitated. One of the things I thought is that they would probably look more towards the PSOJ, more towards the management cadre of the PSOJ, you guys, and say, well, look, can you give us some guidance there? Bring me to the forefront of the negotiations. Can you bring wages? Well, probably not as parity, but can you, can your input in that discussion would probably be, it would bring a lot to the table. What are your thoughts on that? Because I think people make decisions on what's going on at the time, and at the time there is a lot of turmoil and upheaval, and people are anxious, of course. So then you have this added pressure for to kind of with the public sector and to get public sector wages right. But what are your thoughts on that, and the input that you can bring to that?
So probably I'll take that, Al.
Yes.
Morning, everyone. So I believe first and foremost, I think most Jamaicans can agree that public sector workers do need to be adequately compensated for the work that they do. Certainly our doctors, our policemen and teachers and so on. I don't think anyone can argue against public sector workers being paid more. It has to be done in a sustainable way, and it has to be done in an overall transformation program. In other words, the Jamaican people must also receive value for money. So I believe we have heard one section of the discussion. I think the other aspect must also be discussed, which is the value for money perspective, and also the overall transformation of the public sector. It's not just about wages, it's also about the service that the public sector provides the wider economy, right? And that, I believe, is an important missing in the conversation. And I hope that as a society, we can begin to look at all aspects of our public service, which must include a public sector that is adequately compensated, but also one that is modernized and can compete effectively, which means that it is highly productive and it is facilitating overall economic activity.
Thanks, that's a good point there. Thank you.
All right. Thank you so much for your question, Al, and the response there from Adrian. Andrew Laidley, let's have your question, please.
Thank you so much, Amashika. Andrew Laidley, Jamaica Observer. I wanted to piggyback on that issue that Al just brought up with regards to the public sector wage bill being that target that they want to keep is 9%, or they want to get it down to 9%. But here's what I want to find out, is that given the current circumstances, right? And we've seen, as Al said, the posture of public sector workers. I would want to know what you would say are the real initiatives that the government can take in terms of keeping the wages within that target that they want, given that there is a likelihood that the posture that is being taken by these public sector workers could want to push it beyond the target. So I know you mentioned increasing revenues, and I think you had mentioned some other options. I just really want to know, what would you ideally recommend at this time, given the circumstances within the economy?
So let me take a stab at that, Theodore, as well.
Sure.
So government finances must be sustainable. We have seen in our recent past where attempts by governments to spend beyond the country's capacity have led us to financial crises and questions around the solvency of the country. So anything that we do, including paying our debt, paying our public sector workers and so on must be done within a sustainability context. Now, as it relates to public sector wages, as I indicated before, the 9% of GDP capped is not a number that was plucked out of the air, right? It's done within a context of sustainability. It's done within a context of debt reduction and overall getting the government on a trajectory where it does not add risk to the economy and crowd out the private sector. So as I indicated before, it's very unfortunate that we are singularly focused on wage increases in the public sector, as opposed to public sector transformation, which includes paying people more, but equally, there's a focus on how do we modernize government, how do we attract great talent within the public service, and importantly, how do we ensure that the public service, the public sector becomes that enabling sector that drives overall economic growth. And that is a discussion that we need to be having, as opposed to discussion about wages and salaries and trying to get more of a pie that is not growing. Daddy?
All right. So Andrew, I hope that will satisfy a response for you there. Somebody needs to mute. At this time, I'm going to go over to Donovan Wignall. I see a hand raised. Donovan, you have a question or a comment to make at this time?
Yes, Amashika, just a quick question. This probably is for Adrian or Theodore. With the recent interest rates coming out of BOJ, how do you think this will impact not just the MSME sector, but the borrowing Jamaica business sector? In terms of employment, in terms of inflation, in terms of possible recession, and what are the alternatives that the BOJ could employ currently outside of raising the interest rate?
Adrian, I'll go. All right, good. All right, so we've seen where it is that you know well, in other countries, let's you know, utilize the Dominican Republic. Good. Initially, they were slow to increase their policy rate, but it is that they have done so. But they are actually grew by 12.3% in 2021, and they are expected to grow by 5% in 2022. Good. They're having issues as it relates to with their current account. They're having issues as it relates to their FX, where initially it had depreciated at a significant pace, etc. Now their inflationary pressure is coming from external sources, and I you know, utilize the DR to draw a parallel with Jamaica. Locally, in fact, last year we saw where we had a moderate current account surplus. The depreciation rate was relatively subdued. Good. To the extent that growth, yes, was 5.4%, but it was recovery. Our view is that the Bank of Jamaica should not have increased the policy rate by as much as it did, because of, you know, the source of the inflation. It's not a case of that inflation is demand driven. It is being cost push. You know, Mr. Pandohie, etc., yourself, or engage in buying and selling of goods. You see where it is that you know, the cost of import is going up, the cost of shipping, etc. So it is actually that which is driving the inflationary impulse, and not as a result of a demand phenomenon. So we do think that the Bank of Jamaica, in terms of its response of 450 basis points adjustment in 6 months, is significant, and it's reflected in terms of the slowdown in loans. At least the business sector, you're seeing it. We saw that graph. Now there's a lag effect in terms of the impact on growth. Good. If it is that interest rates remain at these levels for an extended period, with the slowdown in growth to the business sector, which will actually lead definitely to a reduction in investment, and you will see it on the growth side in terms of lower growth, you know, over the medium to long term. So, you know, it is very concerning on our part regarding the rate, the pace of adjustment from the central bank and its implication with respect to the growth outlook for Jamaica.
I just want to add to Theodore's comment. So there are a couple of things that we need to look at. The one is the policy rate of the Bank of Jamaica, which is now at 5%. But the other important factor that must be considered is what we call financial conditions. And financial conditions simply mean the conditions that you face when you go to get a loan, for example. So if the BOJ rate is at 5%, but if you look at 30-day rates, for example, 30-day T-bill, the last auction came out about a 7.7% yield. So if the rate on a 30-day instrument is 7.7%, just imagine what the 1-year rate is, the 2-year rate is. Imagine if you're trying to borrow for 10 years. So it's telling you that financial conditions are extremely tight. So raising interest rates by 5% and having it there at that level is one thing. But then the other things that the Bank of Jamaica is doing in terms of its open market policy operations, it's buying and selling of securities. Those things are driving up interest rates also in a very, very significant way. As I indicated before, 30-day rates are close to 8%, which means that if you're a business trying to borrow for 2 years, 5 years, forget about 10 years, I don't think anybody's lending for 10 years, then it means that your business is going to have a very, very hard time rolling over loans or borrowing for any reasonable period. And that's why the PSOJ, the EPC, has been very, very concerned about not just the policy rate, but financial market conditions. So I want to make a distinction here. I know we have journalists on the line. So it's not just the overnight policy rate of the Bank of Jamaica, but what we call financial market conditions are also very, very aggressive. And I believe it is squeezing the economy at a level that we can't afford.
All right, it has been a very...
Yeah, what are the alternatives to interest rates? Sorry, Amashika, that wasn't addressed.
Right, so first and foremost, let's say that you believe the Bank of Jamaica that inflation is a problem. Then the question is, how much of a problem is it? And therefore, the adjustments that you should make. What we're saying is that the alternative from the Bank of Jamaica perspective would be to calibrate properly monetary policy in terms of its overnight policy rate, and also financial market conditions shouldn't be as tight as they are right now. So in terms of, Mark, to your question, I believe the economy or the financial markets require a fair bit of calibration to ensure that we have a properly functioning yield curve. Because I don't think portions of the yield curve in Jamaica right now are active. I don't think people are utilizing, for example, the 5-year segment, the 10-year segment, even the 2-year segment. I believe rates are way above, I believe, what's feasible given demand conditions. And that is definitely something that the Bank of Jamaica should take a look at.
Adrian, do you think that...
Hold on, because we have quite a few questions coming in and a few hands risen. I'm just going to take one from the chat that was also submitted here. Do you believe the government should reduce the primary surplus target to facilitate spending more on welfare programs at this time? Would like to take that one. Adrian?
I can jump on that. Yeah, I can take a look at that. So the first thing to recall, and certainly those of us who follow the government's accounts closely, is that the primary surplus has actually come down in recent years. Recall, it was about 7.1% in 2019. It was adjusted to 3.5% in 2020 to deal with the pandemic. This year, it has gone back to 6.3%, and then it will fall off over the next 2 years. Now, the key thing to remember about the primary surplus is that it has a direct impact on debt reduction. Now, debt reduction is a chief policy anchor for fiscal policy in Jamaica. And as a country, we should be laser focused on reducing the debt in a sustainable way. Now, importantly, and recall, it is this laser focus on debt reduction and the discipline to maintain a healthy primary surplus, where we have seen the debt reduce from 150% a few years ago to us now being on track for the debt to fall to, I think, 69% in 4 years' time. Now, what happens if the primary surplus is reduced below a level that's not consistent with debt reduction? Now, first, the fiscal deficit will go up, the government will borrow more, it will crowd out the private sector, it will have to increase taxes to convince the market that it is viable, that is, government finances are viable, and we'll be back to square one. So I do not believe that is a trajectory or where we want to go to. But there still is a question that I believe proponents of a reduction in primary surplus should make their position a little bit clearer. Reduce to what? So what is the level that the primary surplus should be reduced to? Because just to say reduce the primary surplus is not really saying a lot, right? So if you're a proponent of a primary surplus reduction, you also need to say reduce it to what level?
All right, one more from the chat. We're seeing a bit of a buzz and activity with companies listing on the junior stock exchange. So do you think the JSE will continue to perform well? Who wants to take that one?
Okay, I will go. Generally, stock market activity is heavily dependent on the state of the economy and the expectation with respect to growth. The usual thing is that if the economy is slowing down, etc., you don't see significant activity. Where it is that you're seeing activity, though, is in the junior market, notably not in the main market. Good. We see where it is that some of the multiples are relatively elevated. It's a matter of whether it can be sustained. From my perspective, I don't necessarily think that the high multiples can be sustained indefinitely. So at some point in time, the level of activities will trend down. But for now, there are many active individuals who are in the market. There are some stocks that are out there which individuals have a relatively high expectation in terms of their growth outlook. And I think it is that there's a bit of overzealousness on the part of some investors. And as a result of that, we're seeing the prices go up and some of the multiples are just out of the ballpark. And consequently, I highly believe that down the road, you will see a slowdown, at least in the junior market. But all in all, to the extent that we continue to expect growth in the economy, right, barring no inflation, then in the general theme is one where you will still expect to see the stock market perform reasonably well. But for now, you're seeing a particular segment of the stock market, a whole lot of buzz, going around it, and I don't think it will happen. It will continue indefinitely.
So having said that, the stock market, the junior stock exchange, has been a success. It's one of the best source of funds for expanding business. We have seen a number of micro and small, medium-sized manufacturers listing, and their subsequent results have been very, very positive. So to answer interest rate, an alternative for companies put themselves in order and list on the junior stock exchange as a source of fund. I mean, that's a positive trajectory. I think that's something that we should continue to encourage, especially for the productive sector.
Hello?
Thank you so much, Theodore and Richard. I must say thank you to everyone. So I am going to ask Wesley Hughes. You had a hand raised.
Thank you very much. Can you hear me?
Yes, we can.
Okay. Coming back to this issue of fiscal versus monetary, the government and the Bank of Jamaica, in a sense, have 4 constraints working against. One, the government has given a commitment that no one will be worse off in terms of the wage adjustment or compensation package, which is likely to see the wage bill being above the targeted 9% and maybe closer to 11%. That's one constraint. The next one is the debt reduction constraint, getting down to 60, 65, 70% in a relatively short period of time. The third one is the independence of the central bank, which is the most important reform that we have taken in the last 20, 30 years, in my view, because this means that the fiscal dominance that we saw in the past is now shifted to monetary policy dominance. There's very little game in town other than what the Bank of Jamaica is doing in terms of its policy rate, and that's what we've been focused on. But that's a direct outcome of inflation targeting matched with genuine independence of the central bank. And this independence means that the bank's own projections and own modeling and own view of the future is probably the most critical thing we need to focus on. Historically, we have focused on fiscal indicators. I think we have to pay more attention to what the Bank of Jamaica is doing and saying, and the modeling and the expectations and the communication that that is coming out of Nethersole Place vis-a-vis Hero Circle. The point that Adrian raised about the need for restructuring of the public sector to get greater efficiency, which ultimately will lead to some adjustments in terms of numbers. If you can't keep the same numbers, pay more, and do nothing about technology and restructuring and get the efficiencies that we need. And that is going to run up against this commitment of no one being worse off. So I think we are in for a rocky time in that respect, and something will have to give. My question to Adrian is, out of these 4 constraints, which is the more likely to give? Because we can't hold all 4. We can't do them simultaneously and maintain internal and external balance.
Yeah, no, that's a great question, Wesley, and I love how you've articulated it. The independence of the central bank, that's now institutionalized, and so I don't believe that's a variable that will be impacted. The one constraint that I believe has, let's say, less firmness to it is this commitment in terms of no one being worse off, and what that means. What does not being worse off means, right? Because as you rightly said, to keep the same numbers, to pay more, and to maintain your debt reduction trajectory may run you into some optimization issues or some just simply balancing the numbers. And I believe that is the real conundrum that the government faces, right? And why, quite frankly, I use the term public sector transformation, which is not a euphemism, right? Because real transformation will consider technology, outsourcing, which could get you to lower numbers and without impacting the quality of service that we enjoy from the public sector. Could, in fact, with outsourcing, with technology improvements and so on, could actually improve the productivity and overall service that the Jamaican populace receives from the public sector. So I believe that is where, if we're serious about reform, that the government will have to look at in terms of what exactly it means by saying nobody will be worse off. What does that statement really mean?
At the same time, we have to be mindful that in any government, the timing of transformation is critical, especially they move closer in the re-election, in the election process. That's a major issue we've seen globally. Many countries are showing a tipping
price
point of social.
increases. So Richard?
Sorry?
I'm saying, Richard, this question is to you. Are you hearing me now?
Yeah, I was talking, but go ahead.
Right. How have you been able to manage the increased costs in your business? And how have you been able to maintain margins by passing on price increases?
I'm going to speak on what I consider to be on behalf of what I've seen happening in general, right? So, we're speaking a lot about the macroeconomic indicators, but one thing that is really impacting all of us is the supply chain constraints. That's a real headwind to economic growth and will be a major impact on the macroeconomic indicators, many of which were discussed. We're talking about pricing, but supply availability is going to be a big issue and will likely to get worse over the next few months. So what has been happening, if you look at a lot of the results, I can speak in my case, margin compression is real because the kind of price increase that are being faced is very difficult to pass it on to consumer and not get demand destruction. You can price to a point where people just can't afford to buy a product. And so we're seeing that impact, that situation now, we're seeing a slowdown in demand. It depends, it's in the merchandising and optional area. In the case of the service sector, there's actually a resurgence in demand. They call it revenge consumption. So I think overall there's margin pressure and it's likely to continue because, as Theodore said, that inflation is likely to be lower, but actually I think the rate of inflation is going to be low, but inflation itself will remain high. That's my opinion. And so I think that situation won't change. I think pricing pressure will continue. I think companies are going to have to look within very strongly. We talk about the public sector transformation, require productive sector transformation too. So as we look to improve our productivity, that has been a challenge within our economy. And I think that this has to be addressed in a serious way if we're going to find a balance to kind of keep our demand sustainable and be able to continue business in a real way.
Rich, can you go back to the point you were making before that question? You were making that point. Can you go back to that?
I'm not clear if you're hearing that all, Amashika.
So, they're hearing you, Richard.
There's a question being asked about, you're making a point about the timing of transformation.
Yes.
Right? I think I would like you to just complete that point and, if possible, just unpack it a little bit more.
Right. So I'm saying we talk about all these things on the macroeconomic and et cetera, but at the end of the day, a government has to be elected, right? It has to be elected by the people. And social pressure is a real situation, especially in a country like ours that is dominated by poor households. The inflationary effect is very real and very impactful on poor households. I think that the public sector flexed their muscle in a real way a couple of weeks ago, and literally the country was almost brought to its knees, started to the NWC, etc. I think the government is facing an increasingly difficult time as they have lost too much time between them getting the overwhelming majority to make the transition, to settle it, and to see the impact by the time they get back to the polls. And I think that's a real issue. So I believe that there's a real risk that the government is going to deviate from some of the commitments it has made regard to fiscal constraints, etc., in an effort to ensure there's no social instability. That's my opinion.
Can I ask a question?
Quickly, Al.
Yes, just following from Richard's point and what Adrian was talking about, transformation. He's right. Transformation is going to be the legacy going forward. He's absolutely right. But a point was made in the presentation, and it's a very salient point. The point was made about a rise in gas prices in the US, which is followed by inflation. Some of us will remember Volcanomics and what that did and the rest of it. But what we're seeing there is that inflation is dominating everything. It's almost like being in the ring with Mike Tyson. Instead of punching back, you're guarding because you're waiting for that haymaker punch to come through. That's going to knock you out. And I think that's dominating the discourse. But what do you guys think? You're seeing some countries subsidizing foods. The head of the IMF said it last week, that government should be subsidizing energy and food. We see what happened in the UK. Barbados is talking about it. But can we afford to make such a move? What's your view?
So I think it has to be, I take a stab and then Theodore, Richard can weigh in. It has to be targeted. I mean, any country must take care of its most vulnerable people. And I believe the government has been doing that through part spending and just other social spending. For example, the subsidy it is providing on electricity bills and so on, right? But it has to be targeted because the fiscal situation does not support a wider kind of involvement of the government in the economy, certainly as it relates to subsidizing energy and so on. We are not an energy producer. We have a current account deficit that is susceptible to shocks. We are still a very high debt country, which means that our fiscal situation is always going to be, risky until we get the debt to a level that is sustainable, and therefore any involvement, certainly from a subsidy perspective, has to be targeted to the most vulnerable in the society.
To that, I say ditto. But we'll add to it a little bit in that, notably, Adrian spoke about it has to be targeted. Good. We're in an environment where it is that whenever time the government engage in additional spending, where it is that we oftentimes see cut is on the capital side of the budget, right? And we know that the infrastructure of the country, while it is that we're seeing improvement in terms of highways, etc., it's generally dilapidated. So we would not want the government to embark on any willy-nilly spending. It has to be targeted. We have to be mindful that we commit sufficient level to capital spending so as to get the infrastructure to a point where it is that it will induce high level of growth. Of course, it is that with other things that are happening. So, from that perspective and with regards to what is happening in terms of the debt levels, etc., we do not encourage any significant rise in terms of, spending simply to subsidize food, etc. But we do note that there are large groups of individuals in the country that are vulnerable, and as such, the resources should therefore be targeted at these individuals as opposed to just wholesale spending simply to mitigate the impact of inflationary pressure on households.
Well, inflationary pressure can be approached by another way. It's not only about subsidizing prices. It's also about increasing your local production. So if you increase the supply, then you have an opportunity to reduce the pricing. We just see this happening in many economies now. When you see India stop exporting sugar or wheat, and you see countries, Argentina put an export on, or tax on export to force more into the local economy. Part of it is the expectation that we'll cool inflation in those markets also. That's an issue. And we're not producing enough. We're very highly import dependent, therefore importing a lot of our inflation. And that's the thing that we're not discussing. We talk about the crisis of the COVID, but we're also missing the opportunities. We've missed 2 years of opportunities to reset this economy and reset the productive base. We continue to want to ride the one horse of the service sector, and we're not trying to build the pillars of the productive sector. I agree with Theodore. The government needs to move from being a regulator to an enabler for growth. We're not seeing that good enough. Our logistics central position, Jamaica is so ideal a place. We're not capitalizing on that. Nearshoring, as a result of the pandemic, the rising shipping costs have given us opportunities. And several companies in Jamaica have seen quadrupling of their export numbers. So we're not capitalizing, and we continue to play in a very defensive position. It is a cricket match. And we need to kind of open up and go for some boundary shots now. And I mean, we're missing those opportunities. I think that is something that I am personally disappointed about. I think that, we talk about reducing debt, etc., but it's really a debt to GDP. I think we should focus on the growth side of it. And we have an opportunity to grow, and we're not moving out fast enough. We're too defensive minded, and we're not willing to take the big shots.
Thank you so much, Richard. The very last question is from Mark Tracy. Mark, are you still with us?
Hi, Amashika. I was holding my hand how long, I couldn't hold it any longer. Richard, Adrian, Theodore, thanks for the fulsome presentation. But I think my question and comment ties into everything that was, started from the point that Donovan raised around interest rates and going into Wesley's Hughes point about the fact that the BOJ as an institution is very much critical in terms of the overall puzzle that we're looking on in terms of monetary policy and growth. With that, given the ongoing interest rate, increase that we're seeing and the nexus between that and growth, I think the missing element right now is the responsibility of the BOJ. The rhetoric coming from them is around, for example, where, they're pronouncing growth when really and truly we are in a recovery mode, not per se a growth cycle, right? And, I'm wondering how best can we as an institution, the PSOJ's EPC, form a more formal type of arrangement with the MPC from the BOJ side to look on, balancing between inflation targeting and, of course, the whole process of growth. Because, with the large interest rate, movement that we've seen, we definitely know it will be stifling growth. But the mandate of the BOJ is around inflation targeting. Here we are as a body talking about one of the perspectives around growth. How do we engage the BOJ around ensuring that once we're looking on inflation targeting and pulling the triggers on interest rate movement, ensuring that we also have a perspective on growth? I don't think there's no formal structure that is there, and I think it is needed for the longevity of where we want to grow in terms of the country and growth.
So, Mark, I'll say this. So, I support the independence of the central bank. And independence doesn't necessarily mean, or only mean independence from interference of Hero Circle or the ministry or the government. It also means independence as it relates to the private sector, right? We don't want to be sitting in MPC meetings and to be arguing or to debating with the BOJ.
No, I agree with that, Adrian. But right. That formal interface.
Yes. But we do engage with the BOJ. They are always very welcoming to have discussions with us. I believe the discussions that we are having in Jamaica are very healthy, and it is a part of a maturing economy. And it is, quite frankly, an outcome of having a central bank being independent, which means that ultimately discourse like what we're having will have some impact on how they see the economy. But ultimately, that independence is important. But to your point, there needs to be constructive engagement with the Bank of Jamaica, which we do have. And I must say that the governor and his team, they have been very, very receptive to us. We have had numerous discussions. We have a difference in opinion on certain, policy, directions and so on as it relates to monetary policy and how aggressive they are. But, for the long term, we all should seek to support the independence of the central bank.
All right, thank you so much for that response, Adrian. I know the questions have been buzzing right throughout and we have gone over time, but send them in and we'll see how best to get a response to you all. I would like to invite Richard Pandohie to do the closing remarks at this point in time. Richard?
All right, thank you, Amish. Well, first of all, thanks to everyone for participating, for joining us. I mean, we speak here and we try to predict the future. And I mean, the whole world has predicted the future wrong. Let's accept that. It's a very highly volatile situation. Things are happening constantly. And the world seems to be looking for bad news at every angle to make things happen. If anybody wrote this movie, who could have written a global pandemic once in 100 years, followed by a war in Europe, in the breadbasket of Europe. So, I mean, it's a highly volatile situation. We're an open, vulnerable economy. And what we're going to have to do is to be very responsive and be very agile. I think this forum is what it seeks to do. What Theodore did an excellent presentation. Thank you, Theodore, of showing what exists now. I think we have to keep doing this in a very frequent interval so that business can see what's out there so they can make their adjustments accordingly. So I'd like to thank everyone for participating. Send the questions and we're going to follow up to make sure that we answer them, and give us your feedback on how we can improve and how we can go forward. We need to work together to make this thing happen and to get through this, not only to survive, but I think it's an opportunity for Jamaica to thrive. So thank you, everyone. Have a great day. And thank you to the PSOJ team for organizing this excellent forum.
Thank you so much, Richard. And I would just like to list out all the members of the EPCs. That's Adrian Stokes, Richard Pandohie, Keith Collister, Patricia Francis, Stephen Wright, Stefan Wright, Natasha Richardson, Melanie Sobrati, Miguel Martinez, Theodore Mitchell, Stefani Nugent, as well as Dr. Paris Luai Jr. So thank you all. You can always continue to send us your questions and we'll try to get them answered, but have a good rest of the day. Bye.
Bye.